Introduction to listing without public offer. In the traditional sense, companies raise capital by offering their securities to the public through initial public offerings, IPOs, or follow-on public offerings, FPOs. However, under Chapter 4 of the IFSCA Listing Regulations 2024, there is a provision for companies to list specified securities on an exchange without conducting a public offer. Listing without a public offer allows companies to directly list their securities on recognized stock exchanges like the India International Exchange, India INX, or the National Stock Exchange, International Exchange, without the need to raise capital from the public. This method is particularly beneficial for companies looking to enhance their visibility and liquidity in the market without going through the extensive process of an IPO. Eligibility criteria for listing without public offer. Let's begin by looking at the eligibility criteria for companies that wish to list their securities without a public offer under Chapter 4 of the IFSCA regulations. An issuer must meet specific requirements to list its security without conducting a public offer. They are 1. Regulatory compliance. The issuer must comply with all applicable provisions of the Companies Act 2013 or any other applicable law in its home jurisdiction. The issuer must comply with the rules and guidelines specified by IFSCA and the stock exchange on which the listing is sought. Number 2. Financial health and governance. The issuer must have sound financials, ensuring that its consolidated financial statements meet the requirements outlined by the IFSCA. This includes having audited financial records in accordance with IFRS, US GAAP, or India AS. The issuer must demonstrate strong corporate governance with an independent board of directors and an audit committee in place. 3. No pending legal or regulatory actions. The issuer must not be involved in any ongoing regulatory investigations or legal proceedings that could affect its ability to list or trade securities on the stock exchange. Number 4. In principle approval. Before listing, the issuer must apply for and receive in principle approval from the recognized stock exchange. This approval is necessary for the listing of the specified securities without a public offer. By ensuring that only financially sound and well-governed companies can list without a public offer, the IFSCA protects both the issuer and the investors. Application for listing and filing of documents. Once the issuer meets the eligibility criteria, the next step is the application for listing and filing of necessary documents with the IFSCA and the recognized stock exchange. Here is what the issuer needs to do. 1. Application for listing. The issuer must file an application with the recognized stock exchange seeking approval for listing its specified securities without a public offer. 2. Filing of documents. The issuer, through its lead manager, must file the following documents. 1. Offer document. Although no public offer is made, a detailed offer document must be prepared. This document includes material disclosures regarding the financial condition of the issuer, its governance structure, financial model, business model, and risks. 2. Due diligence certificate. The lead manager must submit a due diligence certificate confirming that the issuer complies with the IFSCA regulations. 3. Disclosures. The offer document must contain key information such as 1. Risk factors, outlining potential risks associated with the company's business model or operations. 2. Financial information. Audited financial statements for the last 3 financial years or since incorporation, whichever is shorter. 3. Management details. Information on the company's management, including the structure of the board and the qualifications of the key managerial personnel. 4. Public disclosure. The offer document will be made available on the websites of the IFSCA, the recognized stock exchange, and the issuer, allowing for transparency and public access. By making this information publicly available, the IFSCA listing regulations ensure that investors can access all material disclosures before trading in the listed securities. Compliance and post-listing obligations. After the specified securities are successfully listed, the issuer must comply with several post-listing obligations to maintain transparency and ensure smooth operations. Post-listing obligations include quarterly and annual financial reporting. The issuer must submit audited quarterly and annual financial statements to the recognized stock exchange. These reports must comply with the applicable accounting standards such as IFRS, US GAAP or India AS. 2. Material event disclosure. The issuer must disclose any material events or changes in its operations, management or financial performance that could affect the value of the listed securities. This includes mergers, acquisitions, changes in the board of directors or significant financial developments. 3. Corporate governance. The issuer must maintain high standards of corporate governance, ensuring that its board remains independent and its audit committee continue to oversee financial reporting and compliance. These post-listing obligations ensure that investors have continuous access to important information, maintaining trust and transparency. Delisting of securities without a public offer. There may be instances where a company wishes to delist its securities that were listed without a public offer. Under Chapter 4 of the IFSCA regulations, the delisting process follows specific guidelines. If a company chooses to delist its securities, here are the procedures they must follow. The issuer must apply to the recognized stock exchange for delisting. The recognized stock exchange will review the issuer's request and may approve the delisting subject to certain conditions. The issuer must notify all stakeholders, including shareholders and investors, of its decision to delist, ensuring transparency throughout the process. The IFSCA listing regulations ensure that the delisting process is conducted in a manner that protects the interests of all stakeholders. Advantages of listing without a public offer. Listing specified securities without a public offer provides several key advantages for companies and investors alike. These advantages include 1. Enhanced liquidity. Even without raising new capital, companies can provide liquidity to their existing shareholders by listing on a recognized stock exchange in IFSC. Global visibility. Listing in GIFT City or another IFSC offers companies access to global investor base, enhancing their visibility and reputation on the international stage. Simplified process. Since no public offer is made, the listing process is often faster and less cumbersome compared to an IPO or FPO. This allows companies to focus on their business operations while still benefiting from a listing. Regulatory flexibility. The IFSCA listing regulations provide flexibility for companies looking to list without conducting a traditional public offer, making it easier for foreign entities to enter the Indian financial market. Overall, the ability to list without a public offer provides companies with an efficient way to assess the benefits of public trading while maintaining operational control and flexibility.